The second method that we're going to look at, so we're done with cost plus method, right? The second method is the market-based approach. We'll take this one quickly, market-based pricing. Here, what we are saying is that you are using marketing approaches. Yeah. And this is based on three things. The first one is product life cycle, which we touched when we're talking about life cycle costing. So I'm going to go through it again quickly. We won't spend time on it. Yeah. My battery is running. Okay. So product life cycle is the first one. The second one is it can be based on new product strategy, or even can be based on existing product strategy. So flashback to where we're coming from. 3 methods to get your costing. Sorry, 3 methods to get your pricing. The first method is cost plus to get your pricing. The second method is market-based. The third method is demand. Yeah, we've not dealt with demand method. We have looked at the cost plus method to get our pricing. Now, the second one that we're looking at is the market-based one, so to get pricing. And we said that can be based on these 3 different scenarios. Yeah, those 3 approaches. Right. So if you're using product life cycle, what product life cycle is just saying, this is more theoretical, no calculation. Yeah, so listen and understand it. Remember that when you have a product, every product goes through similar cycle of introduction, then it grows, then it matures, then it declines. So you practically have this section. You remember your product life cycle. This is your introduction. So you introduce the products here. The product grows, it matures, where sales stabilizes and starts to decline. Right? If you understand the product life cycle, then you will know that you cannot practically charge the same pricing in the same stage. Look at when you are just introducing that product. What do you want? You want market acceptance, right? So you want to do everything to make your product attractive. So here you might even be looking at giving discounts just to be able to penetrate that market. You might be charging very low price. Yeah, there are a lot of risk. Your risk is very high here. Very high risk because you don't want that product to fail. So you are going to be putting a lot of effort to make things work. And in that case, your cash flow will probably be negative here and pricing might be low. But by the time you start growing, you are probably much better and you are able to charge good price at this point. Yeah. But your cash flow will not be negative. At the same time, it's not likely that it's positive because you are just growing. So you expect your cash flow to be neutral, which means 0. It's not negative and it is not positive. But you're able to charge a good price, and maybe even if you are lucky, you don't have competitions, nobody's coming in to join you in that market. You might get to a point where your cash flow becomes positive. Yeah. And you might even keep increasing your price if you are alone in that market. But no matter how good this price is, if competitors come in, the price will crash. Because remember, the higher the supply, the lower the price. Yeah, because you have a lot of competitors. If you need to keep getting the kind of sales you were getting before, you need to keep dropping your price to stay attractive. But by the time that the product has matured, it means that it has peaked, right? In that case, your cash flow definitely will be positive at that point. Because this is when you are making a lot, yeah? Your price will still be good as well because you are still high up there. But remember, you might be spending more money now to rebrand because you have matured. Yeah, you might need to do some remarketing as well at that point. So your cost profile might be going up, right? So profitability will start being at risk. And that's why the next stage is a decline where it is practically difficult to charge high price. Because at this point, the product is even dying. So your cash flow for sure goes back to negative. So that is it with the life cycle approach. Let's look at new product strategy. So this is all you need to just know for life cycle approach. The fact that you can charge different prices across the different stages of the life of the product. You can't charge the same price here, and as here. You have to be aware of the stage of your product and being able to charge the appropriate price. The second approach in that market-based approach is the new product pricing. And when we say new product, it means that nobody is selling that product in the market. We are the first person to introduce the product to the market. Nobody has it. So invariably what we're saying is that there's monopoly. And if there's monopoly, the first approach, the first pricing strategy you can use there is called the price skimming. For people that are doing SBL, you probably have seen this before. You know what that means? Skimming, price skimming. Any idea?
I have an idea. We target a niche market and we charge them high prices.
Fantastic. Fantastic. What we are saying here is you charge high price, low volume. And you can imagine why there will be low volume because you are targeting a small area of the market. So you do this if, number one, yeah, there's monopoly, because if you go and do price skimming in a competitive market, your going concern is gone. So there has to be a monopoly where you are the only one dictating the market. You are the only one controlling the market. You are the owner of the market practically because only you supplies the customers what they want. So the customers are at your mercy. You decide your price, you decide everything. You call the shop. Yeah. And you have this monopoly either maybe because there is high barrier of entry. If you remember your BT, yeah, or you have a patent, yeah, which you are the only one that has, nobody else. It might even be a strong brand that is creating this for you. Just this way Coca-Cola has created that spot for themselves, and up to today, they have the monopoly of that market. Pepsi is never the same thing as Coca-Cola. There's no drink that tastes like Coca-Cola. And no company has been able to come into that space. Right. Yeah. And also, you must be targeting a small market for sure. A small portion. Yeah, a particular part. Yeah. Because not everybody will be able to pay this high price. So you must know where to go and sell the high price product. Yeah. All right. What are the advantages of using market skimming? Right. First one is the fact that there is low risk. And you wonder, why is it there is low risk? There is low risk because you are targeting a small part of the market. So if you are targeting small part of the market, definitely you'll be having low investment. So you have not put so much at risk because you are targeting just a small part where you want to sell at high price. Remember, your revenue is quantity times price. So if you want to get high revenue, is either your price is high or your quantity is high. So what you are doing here is high price, low quantity. You still get your high revenue, which is your bottom line that goes to your profit. Yeah. So you can decide to cover your cost in any way. But if you even have little quantity, definitely your cost is low. So you don't have so much to lose. That's why it's an advantage for this method. So low risk. Likewise, you have an allowance for error. So there's allowance for price adjustment. Yeah, because if you go market skimming at very high price and nobody's buying it, you can come down to their level and sell at their price. And you're still going to be profitable. Remember, your market skimming is just you want to make a lot of profit. Yeah, I just want to take advantage of that small sector of the market that believes that buying expensive things is class. Buying expensive things is qualities. Some people just have that perception. It's not everything that's expensive that is good quality. Yeah, but for sure, some expensive things have good quality, but not all the time. Yeah. And likewise, it might strengthen your brand because there might be a perception that you are a supplier of quality products. That you supply quality product. Yeah, because people just believe that because it's expensive, it's of good quality. So that might create that perception. Yeah. So that's the first method, market skimming, price skimming, if you are introducing a new product. Another method you can use if you're introducing a new product is price penetration. You can do penetration pricing. And I mentioned this earlier. What you are just saying here is that you are charging low price. And when you charge low price, the whole world can afford it. The 9 billion people can buy. So if 9 billion people can buy it, your revenue will be high, even if your price is little. So this is about low price and high volume. That will still give you the revenue that you want, right? So this is the opposite of market skimming. Yeah. Any question? But you will realize that there is a risk involved in this one, unlike the market skimming, because here we are producing so much volume, anticipating that market will buy all the volumes for you to be profitable, because you're going to be pricing your products maybe at marginal cost. So if you are not able to sell enough quantity, you might not be profitable because you won't be able to cover your fixed cost. So that risk is always there. The risk that large volume as anticipated is not sold. Therefore, less profitability. Yeah, because your fixed cost is not covered. And why do you think you will use penetration pricing? Yeah, we've said that for skimming, the why you will use it is because you are operating a monopoly and as well targeting a small part of the market. But when do you think you should be using penetration pricing? Yeah, you can think about it. You can try and make sense out of it. Why will you decide to charge a very low price?
High competition.
Exactly. If there is high competition, you have to charge low to penetrate the market. Because if the competition is so tough, there are so many people selling the same product. Remember, you're coming in and you want to enter in the market, and you discover that, okay, if I go into this market, there will be competition. So you anticipate that there will be high competition. Remember, because this is a new product now, yeah, you are the first person going in, but you know that there's low barrier to entry. So which means you're anticipating that there will be competition in a short time. So despite the fact that it's a new product, barrier to entry is very low, then you're expecting that a lot of people will come and join you in that market. So you want to quickly go in at a very low price, mob a lot of customers as much as possible, because if you are able to take them before competitors come in, customers are naturally loyal. If you keep giving them what they want, change is difficult for everybody. They will stay with you until it's really significant enough for them to leave you and try another person. So if you anticipate high competition because of low barrier to entry, then you want to do penetration pricing, which is a low price, high volume strategy. Yeah. Also, another reason why you might decide to do penetration pricing is if your initial cost of investment is high. You might be tempted to be aggressive with recovery because you want a payback that is quick. So because of that, you want to sell a lot of volumes. You want a lot of cash flows to recover your initial cost of investment. And remember, you might be thinking, the only way I'm going to do that is to get high revenue, and high revenue from high volume. That is the strategy you want to do times low price. This is your penetration pricing, and this is what you're anticipating to achieve so that you can recover this initial cost. Those are the two strategies for new products. The third one we touched on for market-based approach is the strategy for existing products. And this one has so many strategies. All of them you must have heard before. Yeah. For existing product, what we are saying is that someone is already selling a product like that, at least something similar. So you are not the first person. So it's not a monopoly, number one. You don't have a monopoly market. Yeah. The best, maybe best, you say you have oligopoly. So which means you have few people playing, but there is no monopoly. You are not the only person. No monopoly. Best oligopoly, but at worst, very competitive market. If you find yourself in this kind of situation, what are the strategies of pricing? The first one you might do is average pricing. Average pricing. And average pricing is saying you don't want to set the price, but you just want to look at the market and see what is happening in the market. What are the customers already paying for? The key market players, what is the price that they are charging? Yeah. So here you are using the price currently charged by key players. It's like you want to start selling groceries in Canada. The pricing has to be below, or worst case scenario, the same as what Walmart, Sobeys, all of that, basics, all the prices that they are charging. Because if you charge more than that, nobody's going to come buy any groceries from you. So you need to look at the big players and check how much they are selling, and you have to sell at that price. That is strategy for repricing. You can as well do premium pricing for an existing product. And you know what premium means? Premium means you are charging high, actually. Yeah. But how are you able to do that? You are only able to do that if you're able to create a perception, yeah, that makes those customers to think that the product you are bringing in is of a different quality. You have to be able to do that. Either through the packaging or through the marketing, you just have to find a way to do that. So here you are charging high price by making the products look like a better quality. So remember, I'm not saying it's a better quality. You are just making it to look like a better quality, which means you're just playing on the emotions of the customers. So they will look at it and they'll just say, wow, this has to be different. Yeah. If you buy some wristwatches in some places, you see the packaging, you feel like this has to be cheap. Well, you see some also cheap wristwatches, they put in a nice boxes and all of that. And you'll be thinking, yeah, this is a quality wristwatch, but it's not anything different from the cheap ones. But just the packaging alone creates that perception like you are looking at a different type of wristwatch. Another one for existing is discount pricing. Yeah, discount pricing is similar to penetration pricing. So I've already discussed that. Yeah, because you can also use penetration pricing for existing products. Popular. That's even the probably most popular one you will see. Yeah. Another strategy is complementary product pricing. What are complementary products? Complementary products are those products that must be bought together for them to deliver value. Individually, they cannot deliver value to customer. Another example is like a car and the gas, except it's an electric vehicle, which means it's now the car and the battery. But let's say you are talking about normal carbon transmission type of vehicle. You cannot drive the car without the gas. So that's a complementary product. Let's assume there are no other ways of eating bread. You have to buy butter with it. So bread and butter, complementary, because you can't eat butter on its own. I don't know if Usman can do that, but you have to eat it with something. So you have to get value by combining that product with another product. So the two products go hand in hand. That's complementary product. So what they do here, if you want to use this method, is to charge low on one of the products and charge high on the other. So it's almost like setting trap for the customers. You make the car extremely cheap, but you now make the gas very expensive. So customers will buy the car because it is cheap, but they need to buy gas to use the car. So the loss you are making on the car, you recoup it plus profit on the price of the gas. Okay? So what we're saying is you recover low price or profit, yeah, from the other products. So if you have A and B and they are complementary, A and B must be bought together. What we're saying is that cost of A is recovered significantly from price of B. So price of A is low, whereas the price of B is high. So A will be making loss. This will be making huge profit. So this is your trap. That's the entry point. This is where you lock the customer. Whereas once they buy A, they must buy B. Any question? There is this one also called product line approach. That's another strategy. This one is interesting, yeah, because I'm sure you probably have heard about something like that before, where different type of items are grouped as one product. Has anybody heard of Salad Master before? I think that's the easiest one I can remember. Salad Master. They sell everything corporate. See, whether you're talking about plates, from plates to spoons, to grill, indoor grills, knives, fry pan, different shapes of pot, different sizes of pot, plates, everything. They group it together and they sell as one product. I think they sell $14,000 or something. And they say they are quality pots. You even have warranty on them. You see, it's almost like almost 40 items that they will package together in the carton when they deliver to you. But you buy it as one product. It's something like this that we're talking product line. In that case, what you are doing is that you are not pricing each pot separately. Yeah, you put different pots together, different products together, but you price it as one, so that if one is incurring more costs and one is more profitable, on the average, you are still able to break even, right? So here, many items are sold as a single product. And with that, you're able to achieve average profitability. The last one, I think, is the price discrimination. Price discrimination. Yeah, this one is very easy. You just same products you are selling, but at different prices. Same products, different prices. Obviously, to different customers. Because you can't sell the same product at different prices to the same customer. No customer will buy something that is expensive. We will go for the cheaper one. Yeah, but the same product, you're able to sell to different people. Yeah, but it is important that you make sure that they are not able to cross to the cheaper market. Because remember, it's the same product you are selling to different markets. One you are selling to Pakistan, the other one you are selling to Switzerland. Right. The same product. But you're able to charge very high price in Switzerland or in Pakistan and cheaper on the other place. So you are selling at $50 in Switzerland, but maybe you are selling at $10 in Pakistan. But it's the same product. But you must have a strategy, like I said, for customers not to know, because once they know, they will switch. Or if they know, it must be difficult for them to switch.